All right, let's dive right into the latest results from one of Asia's biggest banks, DBS. Now, in a time with all these economic headwinds and falling interest rates, you'd think they'd be struggling. But they didn't just survive. They actually set new records. So, the big question is, how did they pull it off? Let's get into it. I think we have to start with this quote from the CEO, Tan Su-shan, because it just sets the stage perfectly. We're not just talking about a good quarter. This was a record smasher. And that little mention of ROE above 17%, return on equity, that's a key number that tells you how profitable a company is. When investors see a number that high, they really sit up and take notice. It's a huge signal of confidence and strength. Okay, so before we get into the how of it all, let's first take a look at what they actually did. We're going to start with the big, flashy numbers that really define this quarter. And here it is, the big one, a pre-tax profit of 3.48 billion Singapore dollars. That is a new record for the bank. Now, what's really interesting is that it's up 1% from last year. And you might think, oh, 1%, that's not a huge jump. But you have to remember the context here. In this kind of tough global economy, just matching a previous record is a win. To actually beat it, well, that's a serious show of strength. And that record profit wasn't some kind of fluke. It was powered by record income, which hit a new peak of almost $6 billion. And this is a really important point. It shows their success came from bringing more money in the door, not just from cutting back on costs. That points to some real broad strength across the whole business. And this right here, this is the central puzzle. Normally when interest rates are falling, banks have a hard time. Their main business, lending money, just becomes less profitable. But as we just saw, DBS didn't just tread water, they thrived. So what is going on here? What's their secret sauce? Okay, this is where we get into the strategy. We're going to peel back the layers a bit and look at the exact moves that let DBS really defy the odds and post these amazing results. This is the how behind the what. This slide just lays out the paradox so perfectly. On the left, you see the challenge. Their net interest margin, which is a fancy way of saying how much profit they make on loans, got squeezed. That's the headwind. But then on the right, you see the incredible result. Total income still grew by 3%. So they took a direct hit to their main profit engine, but somehow found more than enough gas from somewhere else to keep speeding ahead. So how'd they do it? Well, it wasn't just one magic bullet. It was a really powerful three-part game plan. First, some smart financial footwork called proactive hedging. Second, a massive boom in their wealth management business. And third, really strong results from their trading desks. Let's break each of those down. First up is proactive hedging. Now, this sounds super complex, but the idea is actually pretty simple. It's kind of like the bank buying an insurance policy. They saw that interest rates were probably going to fall, so they used financial tools to lock in higher rates on some of their assets. This basically cushioned the blow and acted as a first line of defense, which then allowed the other parts of the business to really shine. And oh boy, did they shine. Just look at this chart. This is the second part of their solution, and the picture here tells an incredible story. This is the fee income from their wealth management division. Last year, it was about $609 million. This year, it just exploded to $796 million. I mean, you don't need to be a financial whiz to see that is a massive, massive jump. And here it is in percentage terms, a 31% increase year on year. And it all makes sense, right? This growth came from selling more investment products and insurance. As the interest you get from a simple savings account goes down, wealthy clients start looking for other places to put their money to work. And DBS was right there, perfectly positioned to capture all that demand. It just shows a really successful pivot. And while wealth management was the star of the show, this chart shows it wasn't a solo performance. I mean, fee income was strong pretty much across the board. Look at investment banking, a huge 65% rebound. That was driven by more active markets. Loan-related fees were also up 25%. This kind of diversification is exactly what you want to see in a healthy, resilient business.
So, we've seen how DBS brought in record income. But for any bank, income is really only half the story. The other half, which you could argue is even more important, is stability. You want to know that your bank is built on a rock-solid foundation. So let's look at the numbers that measure that kind of strength.
This number is so important. The non-performing loan ratio, or NPL, basically tells you what percentage of the bank's loans have gone bad. At just 1.0%, DBS's ratio is super low. And even better, it stayed stable. It didn't budge. This tells you that despite all the economic uncertainty out there, the quality of their lending is holding up incredibly well. It's a huge sign of smart risk management. All right, here's another one of those key financial strength numbers, the Common Equity Tier 1, or CET1 ratio. DBS is sitting at a very strong 15.1%. Now, I know, this is a technical term, but stick with me for a second because it's absolutely vital to understanding how healthy a bank really is. The easiest way to think about the CET1 ratio is as the bank's ultimate safety cushion. It's the highest quality capital it has to absorb unexpected losses without, going under. Regulators have a minimum requirement, and at 15.1%, DBS is way above that level. This is the financial muscle that gives everyone, from regular people to big investors, confidence that the bank is totally secure. And when you combine that rock-solid foundation with record profits, it allows the bank to do this: reward its shareholders. They declared a total dividend of 75 cents per share. Now, this isn't just about giving money back. It's a powerful signal from management. They're basically saying, we are so confident in our financial strength and our future that we can be this generous. So Q3 was clearly fantastic. But you know how markets are. They're always looking ahead. What comes next? Let's take a look at the bank's own crystal ball for 2026 as they get ready to navigate this world of lower interest rates. So here's the summary of what they're forecasting, and it's a picture of what I'd call realistic optimism. They think total income will stay pretty steady, right around these record 2025 levels. They're admitting that, the income from loans will probably dip a bit because of rate cuts. But, and this is the key part, they expect wealth management to keep growing strong in the mid-teens. The bottom line, they think net profit will be just a little bit below this year's record. They're essentially saying their new growth engines can offset almost all the pressure from lower rates. And that leaves us with this final big question. DBS proved it has a really smart strategy in 2025. It showed that its wealth management business can be a seriously powerful new engine. The multi-billion-dollar question for 2026 is, can they keep that momentum going? Can this new engine keep firing on all cylinders to offset the pressure on their traditional business? Based on what we saw this quarter, they've definitely built a powerful case. Thanks for joining me.